SPMO is 142% crushes VUG's 100% over 5 years. That 42-point gap means significantly more money in your pocket. Now let's shift gears and look at SPMO's pulling ahead with a 26% one-year return, crushing VUG's 19%. That's a 7 percentage point victory right there. But here's where it gets interesting. Two growth funds targeting the same stocks, yet one nearly doubles the other's wealth creation. That's a massive performance gap. In plain English, think of SPMO as the race car that's already popped champagne at the finish line, while VUG is still grinding it out 42 laps back. That's what 5 years of different strategies looks like. SPMO's 142% return over 5 years is wealth-building territory, the kind of compounding that seriously grows your portfolio over time. Here's where the story takes a turn. VUG doubled your money with a 100% return, but that left on the table line suggests someone crushed this performance. Let's break this down further. SPMO's 26% return over the past year shows consistency. Both short-term momentum and long-term trends are moving together here. VUG's 19% return sounds decent, but the title warns us it's falling short, meaning something else is clearly outperforming it. In plain English, performance consistency is like a marathon runner who leads at every checkpoint. SPMO doesn't just win eventually, it stays ahead whether you're measuring progress at 1 year or 5. Let's dig into the details. Here's the real test. Returns mean nothing if you can't stomach the worst crashes along the way. Here's where things get revealing. SPMO's worst year was a 10% drop, manageable compared to most funds, making it easier to stay invested during downturns. Now let's put this in perspective. A 38% loss isn't just a bad year. It's the kind of brutal crash that makes investors panic and abandon ship. In plain English, when the market turns ugly, VUG investors feel nearly 4 times the pain compared to the alternative. It's like weathering a hurricane while your neighbor gets a light drizzle. Here's the thing though, SPMO's promise sounds almost too good to be true. Better gains with less pain when markets drop. Let's see if it delivers. Let's take a closer look. High returns don't mean much if you're losing sleep over wild swings. Let's see who really delivers value for the risk. Now here's where it gets tricky. SPMO's 0.8 Sharp ratio means you're getting solid returns for every bit of risk you're taking. Pretty efficient risk management here. But that's not the whole picture. VUG's 0.6 Sharp ratio means you took on extra risk but earned less reward per unit than SPMO delivered. In plain English, think of the Sharp ratio like mechanical leverage. SPMO's basically a better machine, converting the same market volatility into bigger returns. It's getting more output from the same input. Here's what really matters. Sortino's smarter than standard deviation. It only punishes you for losses, not gains. Perfect if downside scares you more than upside. Now let's connect the dots. SPMO's Sortino ratio of 1.2 shows you're getting solid returns while keeping those painful downsides in check. That's the real win. But hold on a second. VUG's 0.8 Sortino ratio means you're taking on more downside pain for each unit of return you're actually capturing here. Let's unpack this a bit. All right, who's your pick here? SPMO or VUG? Drop your vote in the comments. In plain English, the Sortino ratio is like tightrope walking with a safety net. SPMO cushions your falls better while still getting you across. It measures how well an investment protects you from the drops that actually hurt. Now let's flip the script. Volatility is what keeps you up at night. Lower numbers mean you'll sleep better when markets drop, making it easier to hold. But here's where it gets interesting. SPMO's 19% volatility is pretty manageable. Moderate swings that won't keep growth investors awake at night, worrying about their portfolio. Let's get into the weeds here. VUG's 22% volatility over 5 years means bigger price swings. Those extra 3 points really test your stomach during downturns. In plain English, VUG's the wild roller coaster here. Expect bigger swings, sharper drops, and a rougher ride overall. If you can't handle the steep plunges, this one's going to test you. But here's where it gets interesting. Maximum drawdown measures the worst pain you'll feel. That moment when panic selling becomes tempting and most investors actually cave. Let's zoom in on this. A 23% drawdown hurts, but it's manageable if you're chasing growth. Most investors can stomach this and stay invested long term. Here's where the story takes a turn. VUG's 36% drawdown over 5 years shows growth stocks can crush your portfolio when markets turn ugly. In plain English, maximum drawdown is like watching a building crumble. One fund loses 2 floors, another loses 4. VUG investors watched way more value evaporate from peak than others. Let's break this down further. Recovery time matters because it's one thing to lose money, but quite another to watch it stay lost for months or years. Let's dig into the details. Over a year holding through losses, that's 443 days. Watching red, waiting for recovery. Most investors can't stomach that kind of patience. Now for the real question. VUG bounced back in 446 days, proving growth stocks can recover fast, even after taking a deeper hit than others. Let's dig into the details. SPMO crushes VUG with a 142% return versus 100%. While dodging the brutal downside, VUG suffered a 38% worst year and 36% max drawdown. Higher returns, smoother ride. In plain English, recovery days measure how far you've climbed from your lowest point. VUG started deeper down than other funds, so even though it took the same time to recover, it traveled further uphill to break even. Now let's put this in perspective. Those tiny percentage points you're ignoring, they're quietly siphoning thousands from your portfolio over time, compounding silently against you. But wait, there's more to this story. At 0.13%, you're barely paying anything for active management. That's incredibly competitive for what you're getting here. Here's the thing though. VUG's 0.04% expense ratio is incredibly cheap. You're keeping nearly every dollar of your returns instead of paying fees. In plain English, think couch change here. One fund skims 3 pennies per 100 bucks. VUG takes just 1. That extra 2 cents staying invested? Over time, it compounds into real money working for you. Now here's where it gets tricky. Despite pricier fees, SPMO outperformed its benchmark, generating alpha by delivering returns that exceeded what market risk alone would have predicted here. But that's not the whole picture. SPMO's manager delivered 4.5% alpha. That's pure skill adding value beyond what the market itself provided. Impressive outperformance here. Let's see how this plays out. VUG's negative 2.6% alpha means it earned less return than its risk level justified. You're taking the risk without the reward. In plain English, alpha is your investment report card, showing who beat expectations and who didn't. SPMO aced the test by beating the market, while VUG fell short of the benchmark. Simple as that. Now let's connect the dots. Concentrated bets mean bigger gains when you're right, but they'll absolutely crush you when things go sideways. But hold on a second. SPMO holds 101 stocks, enough concentration to express real conviction, yet diversified enough that no single position can wreck you. Let's unpack this a bit. VUG spreads its bets across 163 companies, so if one stumbles, your portfolio doesn't crash with it. In plain English, SPMO's got 101 holdings, while VUG spreads across 163. Think of it like the egg basket analogy. VUG spreads your risk thinner, fewer eggs per basket, which typically means less concentrated exposure. Now let's put this in perspective. Megacap concentration shows if you're riding big tech dominance or spreading beyond it, a fund strategy revealed in one number. But there's a catch. SPMO keeps 42% in megacaps. You're getting solid exposure to the giants without putting all your eggs in one basket. Let's get into the weeds here. VUG's betting big on megacaps here. 2/3 of your money rides on just the market's largest names, and that's serious concentration. In plain English, think of this like splitting a pizza. SPMO gives megacaps half the pie, while VUG hands them 2/3. VUG's betting way harder on the giants, concentrating more in fewer massive companies. But here's where it gets interesting. High-tech exposure ties your portfolio's fate to one sector's booms and busts. That's concentrated risk you need to understand up front. Let's zoom in on this. SPMO keeps tech at 34%. You're getting solid exposure without letting one sector dominate your entire portfolio. Here's what really matters. VUG's betting big on tech. 51% in one sector means you're riding the tech wave, and that's quite the concentration risk. In plain English, SPMO spreads its bets. 1/3 in tech. VUG, half its eggs in one basket. That's a big difference when tech stumbles. More concentration means you're betting everything on one sector staying hot. Let's break this down further. Higher price to book means you're overpaying for assets. When the market turns, those expensive valuations get crushed first. That's valuation risk. But what about SPMOs trading at 5 times earnings? That's reasonable growth pricing without the bubble risk you'd see at 20 times. Now for the real question, VUG's price to book is 9 times higher. You're paying nearly double per dollar of assets compared to SPMO's valuation. In plain English, think of it like shopping for car engines. SPMO charges $5 per horsepower while VUG wants 9. You're literally paying almost double for each unit of value with VUG. Here's where things get revealing. Fund size matters more than you'd think. Bigger doesn't mean better when execution costs and flexibility start working against you. Now let's put this in perspective. At $13.7 billion, SPMO's big enough for stability, but still agile enough to pounce on opportunities faster than megafunds can. But wait, there's more to this story. So which fund's right for you? SPMO for aggressive long-term plays. VUG for moderate growth with manageable fees and timeline. In plain English, think of it like a road trip. SPMO's the faster route with sharper turns, while VUG takes the highway everyone knows. Your choice depends on how much intensity you're comfortable with. Let's take a closer look. The legal fine print. Do your homework and consult pros before making any investment moves. Now let's connect the dots. If you found this breakdown valuable, hit subscribe for weekly deep dives that cut through the noise with real data.